Oh, hi, Internet. So a home equity loan is a type of mortgage loan where you borrow against the equity you have in your property and take cash back. So what exactly is equity? Well, equity is the difference between what you owe on your home and what the fair market value of your house is. In the investment world or on Wall Street, this is something similar to using leverage. So leverage is an investment strategy where you use borrowed capital to increase the return on an investment. So how does this apply to you as an individual? Well, you can use equity in the biggest asset that most Americans have, which is your house, in the middle of our streets, to pay off debt, to improve the value of your home, or to increase your wealth. So let's start with the basic equity loans available to most consumers. In this case, we're going to talk about your primary residence, the place that you live, because there's other strategies involving investment properties, taking equity against those, but those are a little bit different and we'll go through those in another video. So generally speaking, there are 3 types of equity loans that you can use to access capital from your house. Number 1 is a cash out refinance. Number 2 is a home equity line of credit, also known as a HELOC. The third type, which varies in a bunch of different fashions, is a second lien against your house, typically specifically for improving the value of your home. These are also known as construction loans. So let's start with the cash out refinance, my personal favorite. So in a cash out refinance, you actually take your primary loan that you have on your house, you refinance the entire loan at a fixed rate, adding additional principal balances to your loan and taking that additional principal balance in cash back into your bank account. So you only have one loan. Now, in a traditional rate and term refinance, you usually want to at least lower your rate by 1% in order for that to make sense. The great thing about a cash out refinance is even if your rate is the same, higher, or in some cases it can be lower, it still could be an advantage for you. Because in a cash out refinance, the rate isn't always the most important piece or the reason why you're doing it. So even if you have to take a higher rate in order to do the refinance, sometimes that can still make sense. It all depends on your situation. So when you do a cash out refinance, how much money can you actually get back? Well, the rules vary state by state. So contact your local mortgage professional and ask them for the details. I live in Texas. And in Texas, you can borrow up to 80% of the value of your home. So let's talk an easy math. If your house is worth $100,000 and you owe $50,000, then you can borrow an additional $30,000 in equity. $50,000 plus $30,000 equals $80,000. $80,000 is 80% of $100,000. Now, this additional equity is paid out to you and goes right to your bank account, and you can use that money for anything you choose. So in summary, it's a fixed rate. You have one loan. You can borrow up to 80% of the value of your home. You can qualify for this even if your credit isn't perfect and you have low payments. So what are the drawbacks of this kind of loan? Well, it is a full refinance on your current mortgage. So you have to take your current mortgage, pay it off completely, and create a whole new loan. And with that can come additional fees, just like going through the normal loan process where you have the normal fees associated to a refinance or a purchase. So the cost can be a little bit greater. So the next type of home equity loan is what we call a home equity line of credit, or a HELOC. So this is like having a revolving line of credit on your house, like a credit card for your home, or a credit card backed by your home. Now, unlike a traditional cash out refinance, most HELOCs are on a variable rate, meaning from a year-to-year basis, the rate can fluctuate based on current market conditions. But this comes across as a second lien, so you don't have to refinance your primary lien in order to get this type of loan. So if you have a really good rate on your first loan and don't want to refinance and take a higher rate, then you can do a second lien, the HELOC, and keep your primary mortgage the same. Now, unlike a cash out refinance, HELOCs are capped at 75% of your home's value. So, easy math again. If your house is worth $100,000, you owe $50,000. If you get a home equity line of credit, in most cases, you can borrow up to $25,000 additional dollars, 75% of that $100,000. Another great feature of HELOCs is you don't have to take all the money at once. If you just want to have it available to you so you need it for a rainy day, it's a pretty good option. Like a cash out refinance, you get one lump sum. But with a home equity line of credit, you can take draws according to when you need the money.
Where's the money, Lebowski?
And in most cases, the fees on home equity lines of credit when you actually go through the loan process are a little bit less, and the process actually goes a little bit quicker in most cases. But typically, when you do a home equity line of credit, your financial situation has to be a little bit better, meaning you have to have a little bit better credit, got to have a little more income, got to have a little bit of cash in reserves, just to make the bank feel comfortable in lending the money. And in a lot of cases, you have to have a pre-established relationship with the bank that you're choosing to get your home equity line of credit through. And what I mean by having an established relationship is typically you have to have accounts already with the bank or loans already with the bank, so they have a relationship with you and feel comfortable issuing you the funds.
Cash this check here, and then I'd like to take you out for a steak.
So, let's talk about the pros and cons of a home equity line of credit. Pro, you don't have to refinance your primary loan. Pro, it's typically lower fees. Pro, it's a quicker processing time. And final pro, it's very flexible for use. You don't have to take all the money at once. It's a very flexible loan and you can access as much as you need when you need it. Now the cons. HELOCs typically have higher rates and variable rates. They also typically have higher qualification standards. You usually need a pre-established relationship with whatever bank you're applying for the home equity line of credit with. And for the last one, you have a little less equity or access to equity than you would have with a traditional cash out refinance. So now let's talk about the third type of home equity loan that you can get on your house. So these types of loans are like second liens, what we call construction loans. So you want to build a pool, you want to add on something to your home, a bedroom, a kitchen, renovate your bathroom. This is how you would use these types of loans. So with these second lien construction loans, they're very specific to the bank that you choose to use on how much you can borrow, how the process works. So you'll need to contact the bank and find out what their process is and what their requirements are in order to qualify for this type of loan.
We want to take out a hefty loan.
In a lot of cases, it has to do with the loan that you take out, how much value is that going to add to your property once you complete the project. So in some cases, you can actually borrow more that exceeds the current fair market value of your home. I'll give you an example. Easy math time. If your house is currently worth $100,000 and you currently owe $50,000, in some cases, you might be able to borrow an additional $50,000. So it's almost borrowing as much as your house is worth if that additional $50,000 will also improve the fair market value of your home. So if your home's value increases to 120 or 130 or 150,000 because you put that 50,000 in, then you might be eligible for that type of loan. Now, these types of loans typically come with higher rates because they're a second lien. On a second lien, that means they're not in the first position of your current mortgage. So if you were to ever run into financial issues and say foreclose on your house, the bank that owns your primary mortgage would be paid first, and the bank that owns your secondary mortgage would be paid second. So if there wasn't enough equity in order to pay the second lien, then they wouldn't get paid. So therefore, they have greater risk. Well, with greater risk typically comes higher rates. So most of these second construction lien homes carry a substantially higher rate than you would on your first one. And typically speaking, because of the higher risk, these loans are going to have stricter requirements when it comes to your credit, your income, and your excess cash. And on these second lien construction homes, in most cases, the cash does not come directly to you. You have hired a vendor, you've gotten a contractor, you've employed someone to do the work, they've provided a bid to the bank, and then the bank directly pays that vendor for the work. Typically speaking, the cost of these loans are a little bit less and the process to get from start to finish is a little bit quicker. So, to summarize second lien construction loans, pros and cons. Pro, it can add direct value to your home. Pro, the loan amount can sometimes exceed the fair market value of your home in its current state. Pro, lower costs in most cases. Pro, faster processing time. Get your loan done from start to finish quicker. So what are the drawbacks? Money is specifically directed to vendors that are doing the work on your home, so it's a little less flexible. These types of loans typically have higher rates, and they can be fixed or variable. It depends on the bank. And number 3, they typically have higher qualification standards because of the risk level. Okay, so now that you've decided a home equity loan might be right for you, how do you decide what type of loan to get and what you do with all that money? Well, the good news is, in most cases, with that money, you can do whatever you want. Here are the most common and effective uses of that money. Pay off debt, upgrade your home, put away for a rainy day, And if you want to get into advanced calculus, take that money and use it to make more money. So, should I or how do I pay off debt with my home equity? Why should you use debt to pay off debt? Didn't mom and dad tell you that that was a bad idea? Well, the truth is, it isn't for everyone. But let me explain. This is all about using what I like to call useful debt to pay off bad debt. So you might ask, well, what is useful debt? Well, some people call this good debt. I don't like to refer to anything as good debt because I think no debt is good debt. But if you're not in a position where you can go and stroke a check and pay off all your debt tomorrow, there is such thing as useful debt to pay off bad debt. So what are some types of useful debt? So some useful debt is an asset-based debt. What asset-based debt is it's debt that you acquire by leveraging an asset and can sell that asset at any time to completely pay off that debt. Another form of useful debt is debt used to start a business. A business generates revenue, which you can also use to pay off debt or support your life. So another form of useful debt is debt you acquire to make you better at life. Well, what does that mean? Well, that's student loan debt, okay? Debt that you acquire to educate or make yourself better at your chosen profession. So student loan debt's a little tricky because not all student loan debt is created equal. In a later video, I'll go into different types of student loan debt, what's helpful, what's not helpful, and which ones you should try to avoid. So, what is bad debt? Bad debt is anything that I would call consumer debt, anything that you're purchasing to maintain or improve your lifestyle. Credit cards for clothes, car debt, any debt that you acquire to pay for something just because you want to, but that doesn't create income, revenue, or education for you in the future. So caveat to the car debt. When we're discussing debt on a car, it's a little bit different. Is it okay to take out debt to get a car so you can get from home to work because you don't have money to pay cash? Well, in life, sometimes you got to do what you got to do. But do you need to go buy a $60,000 BMW for that to happen? Probably not. Stay a little conservative on the car debt if you have to get it. If you can pay cash for it, that's really the route to go and save up for that BMW later on down the road. But car debt kind of falls into one of those categories where sometimes it makes sense, sometimes it doesn't. So, how does useful debt get used to pay off bad debt? Well, this is done by using a principle called cash flow. Cash flow is the net amount of cash being transferred in and out of your household on a monthly basis. The net amount, meaning the cash you have left over. Left over from what, you might say? Well, here's a simple example. Your income is $5,000 a month after taxes. That income then is used to pay all of your expenses. So let's say that all of your essential expenses, essential is defined by everybody a little different, but typically we're talking about household payments, debt payments that you're obligated to pay, food, gas, utilities, things of that nature. Stuff that you have to exist in life. What's not essential? New clothes, dining out, your new iPhone, anything that again is used or spent on to support your lifestyle. So how does this work exactly? Well, let's say your monthly payment on your mortgage currently is $1,500 a month, but you have equity that you could tap into to pay off other debt. And let's just say between credit cards, car payments, student loan payments, or any debt that you have to pay out on a monthly basis, you've got to pay a minimum of about $1,000 a month just to support the minimum payments on those debts. And then let's say you decide to refinance and take $50,000 out to pay off a car that's costing you $600 a month. So of that $1,000 a month being used to support your debt, you remove $600. Now all you have is $400 a month in debt. But your mortgage payment, because you just took equity out, went up by $100. So before, you had $1,000 that was required to satisfy and support your monthly debt. Then you refinanced and removed $600 of that, so you have $400 left. But you raised your mortgage by $100. So now your outlay is $500 a month, where before it was $1,000 a month. So you have an extra $500 a month in cash flow. So now you take that $500 and you apply that directly to your additional debt. Pay down the student loans, pay off the credit cards, make sure that that money goes to that debt and paying it off faster. Now, if you don't trust yourself and you're not good about running up additional debt, if you pay off a car and want to go buy another one, or that credit card is always being charged up, This may not be the route you want to go, but if you can stay disciplined and apply that money, if you're fed up being up to here in debt and you can take that money and apply it to those additional debts every single month, then this will get you out of debt really quickly. The key is open up your cash flow and use that cash flow to pay that debt off faster. Now, let's say you want to add on to your home to give it more value. So these days, home prices seem a little out of whack. People want to move, but they don't want to have to buy a house that's $200,000 more than the one that they're currently living in. Well, the good news is that if you like where you live, but it just doesn't quite suit all your needs, you can use that equity to create the house that you want to be in. Give yourself some more space, add on the man cave, build a pool. Now, the great thing about this is, let's say it costs you $20,000 to $30,000 of your equity in order to make these improvements. Well, that $20,000 or $30,000 might translate into $50,000 to $60,000 in value or fair market value for your home once you decide to sell it. And the good news is that while you do these upgrades, you get to continue living in your home and taking advantage and enjoying these changes that you made. So once you're ready to sell, you'll have enjoyed all the time that you had there. Plus, you'll have that additional equity and that additional value in your home to make it that much more attractive on the open market. And with rates still in the low threes and home prices soaring, this is a perfect opportunity to take advantage of this. Now, let's say you want to take out some extra money just to have a little to save for a rainy day. A lot of financial professionals will tell you that it's a good idea to have 3 to 6 months of household expenses saved in your bank account for quick access. So if you lose your job, if you get hurt, if something changes in your life that causes you to need that money, you have quick access to it. And the downside about that money sitting in your house, in your equity, is that you can't get to that money until you either refinance it and take it out or sell your home. So that $100,000 that's sitting in your account right now or sitting in the equity of your home, you can't get to it anyway if you had to immediately. So doing a cash out to say maybe do your improvement or pay off some debt, but then pull a little bit extra out to keep in savings for a rainy day isn't a terrible idea. Just make sure that you keep it there and don't use it to go on a trip to Hawaii. So the final common use for these equity loans is what I like to call advanced calculus finance, using the equity in your home to create more wealth for your family. Now, this method isn't for the faint of heart, but this is how all the big boys take their wealth and grow it exponentially over time. It's called using leverage. But this is a longer discussion for another day. So for now, I'll just sign off and say, I'm Mike Mills with Verity Mortgage. Be great humans, and we'll see you soon.